Hey future millionaires, this is Phil from the Next Chapter team, and in this video we're going to review 4 mutual funds, talk about what a mutual fund is, look at what your balance would be if you bought all 4 mutual funds consistently for a 5-year period and a 10-year period. Before we jump into the review, please take a moment to like, subscribe, and share, and thank you so much and enjoy the review. Okay, in this review we're going to go over what a mutual fund is, how to buy them, and then we're going to do a deep dive on the following mutual funds. A Mellon fund, a Barnum fund, a Oberweis fund, and a Fidelity Select Construction and Holding portfolio fund. That's a sector play. Okay, a mutual fund is an investment vehicle that consists of a portfolio of stocks, bonds, and other securities. Investors are able to invest in these funds that are professionally managed, and mutual funds are divided into many categories that we'll go over, and mutual funds have end-of-day pricing. Mutual funds are accessible through 401ks, IRAs, and even brokerage accounts. So from when you want to go to a mutual fund, you need to figure out how you're going to access it. You're going to go to either an investor or a 401k usually. So an investment brokerage account or a 401k. So then you decide on the frequency. If it's your 401k, it's going to be the same frequency in which you get paid. But if you're going to do an IRA, we always tell people try to do the same frequency in which you get paid. It just makes your life easier. Then you want to set up the transfer to the investment firm to be automatic. And then you want to make the purchase of the mutual fund to be automatic. Usually we do it like a day or two apart to account for weekends. Now, for each mutual fund, we're going to do a quick recap of what the fund category is, fund description, the weighting of the mutual funds, some shareholder information, some expense information, top holdings, and then, of course, fund performance. Then we'll use that fund performance information to do a nice analysis to see what the balance would be over a 5- and 10-year period of time. First up, we're going to go over the Mellon Dynamic Fund. This is a large cap. This large cap fund has been around since 1995, and it seeks to get normal investments, about 8% of its assets in common stocks of companies. This mutual fund has a total of 76 companies, holdings. Big companies in the top 10, Berkshire Hathaway, JP Morgan Chase, ConocoPhillips, CME Group, Bitcon, Dixon, and a Rensselaer Holdings, LT. So a nice wide array, which leads us to have a nice spread through various sectors, right? You have financials, industrials, technology, healthcare, energy, look at that, and services. You add all those up, you're well over 70% on this list right here. So that's a good, nice weighting, a nice spread of large companies. Again, this fund has been around since 1995, and so just in case you wanted to do this on your IRA, its minimum investment is $1,000. After that, you could do $100. And actually, the IRA is different. It's $75. Minimum investment in a regular brokerage account is $1,000. So minimum investment in the IRA is $750. But after that, you can do automatic transfers in to keep making partial payments, partial purchases of the mutual fund. This one has an expense ratio of 0.93, so that means for every $10,000, it would be about $93 of expenses per year. And what do you get for performance? You get a 1 year of 15.94, a 3 year of 13.77, 5 year of 13.87, and then finally a 10 year of 10.57. These are some interesting and pretty darn good because they're all above 7%. This is pretty good rates of return. Next, we move on to a Barron Focused Growth Fund. This is a mid-cap, and it's been around since 2008, and it focused on mid-sized companies. What companies you say? Companies like Tesla, Arc Capital, Hyatt Hotels, Space Exploration, Val Resorts, Guidewire, CoStar, that's a leasing company, and Space Exploration Technology. So look at that, a nice wide array. Those are your top 10s, and you have a total of 35 holding companies. So 35 different companies in this mutual fund. And a nice little spread there too. So again, you've got a spread of technologies around 20%, non-durables around 20%, other, retail trade, finance, and consumer durables and health. Nice spread. This is your sector weighting. This is a nice spread. This one, minimum investment outside of an IRA is $2,000, but in an IRA is $0. So Again, so if you did this in a brokerage account, this would be $2,000. And then if you did this in a IRA, it'd be $0. So they let you do partial for the IRAs. And then let's take a look at that performance. Your 1-year performance was 12.98, so roughly 13%. Your 3-year, not so great, 2% or 1.92. But that 5-year, look at that, awesome, 23.28. 10-year, 15.23. Now we're looking at a micro cap fund, Oberweis micro cap fund. This is a small cap growth fund. This fund was started in 1996. It invests in companies that have a valuation of between $500,000 and $8 billion. What companies would you say? You got top 10 as following: AR Test Systems, Camtech, Sterling Construction, SI Bone Inc., Bluebird Corporation, and Ultra Clean Holdings. Total of 92 different companies in this fund. Let's take a look at those weighting, the weighting between sectors. You've got about 25% in technology, 17% in other, industrial cyclicals, about 15%, healthcare 13.15%, retail trade of 9%, consumer durables 8.45%, and services 4.23%. Minimum investment outside of a 401k or an IRA would be $1,000. Minimum investment in an IRA would be $500. This one has a fee of 0.15 expense ratio, so that means for every $10,000, it'd be about $150 per year. Let's take a look at those returns. All right, 1 year, 8.87, 3 year, 10.51, 5 year, 16.88, and a 10-year of 13.30. Not bad. For the small caps, this is a nice little spread. Now we're jumping into our last fund. This is a Fidelity Select Construction and Holding one. This is our sector play of this mini portfolio that we put together. This is housing sector only. It's been around since 1986, and it focuses on mid-cap construction companies between $2 and $10 billion of valuation, and this one has a dividend that pays twice a year. So that's nice because you have the opportunity of during your non-retirement years, you would obviously want to reinvest the dividends, but in your retirement years, you may just want to take that paycheck if this isn't a 401k or that dividend payout, not necessarily a paycheck. All right, what companies are in here? Construction companies. So you got Home Depot, Lowe's. You got some extra money sitting to the side ready to make new purchases in that money market fund. You've got Johnson Controls, Train Technologies, their HVAC company, Vulcan Materials, Innovation Homes, Will Scott Mobile Mini Holdings. This is amazing. So you've got, these are your top 10s, and you have 53 holdings as an overall. So you got around 53 companies here that all dedicated to housing and construction. So, and then you have a little different weightings here. So they split that up into weightings of through sectors: retail trade, that's your Lowe's and Home Depot; industrial cyclicals, consumer durables, a little bit of financials, and then some services. Okay, so for this one, if you wanted to do an investment outside of a 401k and outside of IRA, in either way, it's $0. So minimum investments in a brokerage account, $0. So you could do partial shares. You don't have to like $1,000 minimum. And then your IRA, again, $0. So that means, again, you could do partial shares. You don't have a big minimum to invest in this as an IRA account. Your expense ratio is 0.77. So that means for every $10,000 you have invested, it'd be $77 per year. Let's look at those returns. You've got 31.92 in 1 year, 17.2 3 year, 21.72 in the 5 year, and then finally it looks like 14 and change in your 10 year. Now, we're going to wrap up this review with what would it look like if you invested equally. So 25% every year of a total amount every year for 5 years, what would the balance be? And then finally for 10 years, what would the balance be? Now we're going to have some fun. We're going to take it to the spreadsheets. First off, we've got our first fund. This is our large cap that had a 5 year of 13.81, a 10 year of 10.57. Then we're going to go to our mid cap. which had a 5-year of 23.28. That's awesome. And then a 10-year of 15.23. Then our micro funds, aka our small cap, that had a 5-year of 16.88, and then a 10-year of 13.33. And then finally, our sector play, this is our Fidelity construction one. That one had a 5-year of 21.72 and a 10-year of 14.84. And again, for today's analysis, we're going to assume that this is a 401k. And what do you have with a 401k? Even if you're self-employed, you can do this, a match. You have a match. So we're going to say, okay, 6% and then a 4% match. All right, so what does that make you have? That has a balance, a total annual contribution of $7,500 based on a $75,000 salary. Again, so $7,500 in this case, right? Because we're running the simulation. This was a 401k. And there's a 4% match. Whoa, look at that. Your 5-year balance would be $37,500. Now let's walk through that. You, the employee, would have contributed about $22,500. And your growth on your contributions would have been about $16,000 or 26%, 16.6. Your employer would have had a match of $15,000, and that would have had a growth of $11,000. So all in, you would have had $65,299 broken up into various buckets, but a lot of growth there. Overall, so your total principal, $37,500. That's your actual invested dollars. And then your growth, with your growth added, you would have had $65,000. But because we love looking at these numbers and really digging into them, let's see what would happen if you would have did all 10 years. So we change that to 10 years. Whoa, look at that. $161,000. So let's walk through that. The balance would be composed of your contributions to the employee of about $45,000. The growth on your contributions would have been about 32% or $51,800. Your employer would have matched and given you $30,000. And again, you small business owners who are watching this, you are able to do an employer match. You are able to make a contribution on the behalf of the company to yourself, small business owners, and that would have been 19%. And then the growth on that 19% or that $30,000 would have been $34,000. So all in, let's look at this. All in, you have $161,000. But what's really awesome at this 10-year mark is your growth was actually more than your actual contributions. You had $75,000 you contributed. So if you take 161 and you minus 75,000, that is still more than 75,000, right? That is amazing. You would have had more growth in your account than actual principal invested. Hope you enjoyed the review. Please like, subscribe, and share. If you want to see us do a review on some other mutual funds, drop a comment, send us a note. We will be more than happy to do another review on more mutual funds. Just send us the symbol. We'll do it as quickly as we can. Thank you so much. Please enjoy. Bye. Hey, thanks for staying to the end. This video is brought to you by the Next Chapter team. If you enjoyed the video, please drop a comment. Please also like, subscribe, and share for your friends and family. This will help the channel reach out to more people just like you. We offer one-on-one coaching where we work with everyday people to determine a clear path to achieving their financial goals. This includes things like budgeting to reduce debts, planning for big purchases, and even learning how to build wealth with the tools that you have readily available to you. If you're interested, please see our link below to schedule a free call with our team. That's right, it's a free 30-minute call with the team. Also, check out our affiliate links for high yield savings account. This is a great place for the saving up for those big purchases and your emergency fund. Thanks, and see you in the next video.